Uh, okay, Ivo, I'm conscious of time, so maybe we've got nearly 24 people joining. Should we get started, and then I'll admit people as they come in. If you'd like to get us.
Yeah, sure. Let's start. So is everyone admitted already? We can start, or? Oh, you're muted.
Let's get started. Yeah. Thank you.
Okay, well, hi everyone. Thanks very much for joining us for what is now our third Money2030 event. And it's really great to see all these familiar faces, especially in such a busy period running up to Christmas. For those of you who do not know me, I'm Ivo Georgiev. I'm the founder and executive chairman of Paynetics. And today, myself and Mike Peplov, who is our CEO for the UK operation, will chat with this fantastic group of panelists and explore some aspects of the future of financial services. By way of a brief introduction to Paynetics, our vision is basically to make payments a frictionless process, empowering our clients to design, build, and operate financial products at scale, whilst enabling them to focus on their core proposition and core business. To do that, we offer a comprehensive range of payment services framed around a digital banking platform, including banking, card issuing and acquiring, money transfers, e-wallets, etc. The way we look at ourselves is we consider ourselves a regulated fintech, as we combine both the experience of being a pan-European regulated money institution and principal member of the card schemes and the banking rails in Europe, with the ability to provide cutting-edge financial services for our clients. Lately, or for the last couple of years, I mean, through our work, we've seen an increasing trend of clients looking to integrate financial and payment products within their core product offering. Customers, whether business or consumers, are now demanding more and more a seamless user experience in any non-financial ecosystem. And in this rapidly changing environment, we find ourselves in the middle of this embedded finance space, which is growing exponentially. So this one got us thinking whether the embedded finance as a trend is something that's going to change the industry. Is it a paradigm shift? Is it here to stay? Is it here to shape how we do payments going forward, or is it a bubble? So today we are bringing together people with very different background, with different views on the space and the industry. And our objective is to have a open or brainstorming session and try to address this key question. But let me introduce our panelists. I'll ask each one of you guys to say a few words about yourselves, introduce yourself to the participants. So first, maybe we start with Andrea Otaro, Managing Director at Rothschilds. Andrea?
Thanks, Ivo, and thanks for inviting me. My name is Andrea Otaro. I'm a managing director in the London team, joined Rothschild 15 years ago. I'm covering financial institution, and in particular with focus on Central Eastern Europe, Nordic, and obviously FinTech. Well, thanks for having invited me. It's a very interesting topic that obviously is changing completely the landscape in what we're doing.
Thanks, Andrea. And now we go to Alex Mifsud. Alex is a veteran in the payments industry and co-founder and CEO of Weaver. Alex?
Yes, thank you for having me. I guess embedded finance is very close to my heart. You know, Weaver itself is an open platform to enable embedded finance, and by that we mean the ability to integrate financial services into non-financial applications. So hopefully, you know, I'll bring a perspective of our innovators that use our platform to actually create these applications which have embedded financial services within them. Thank you for having me.
Great, thanks very much, Alex. Then we have Alison Donnelly with great experience in the regulatory space and providing us with unique insight into the regulatory background of embedding financial services as a process. Alison?
Thanks, Ivo. I'm delighted to join the panel today. Thank you for having me. I am a payments regulation specialist, as you've mentioned, and the day job is a director of FSCom, which is a boutique compliance consultancy specializing in payment and e-money institutions. So we help firms get authorized. and stay authorized. So we help them understand their regulatory obligations. And we've been working with firms right across the sector, including many who are involved in embedded finance.
Thanks, Alison. And last but not least, we have Tony Craddock. He's Director General of the Payment Association. And Tony has made incredible contribution to the payment space in the UK over the last years. A few words from you, Tony.
Thank you very much. It's great to be here. I'm the Director General of the most influential and largest community of payments industry bodies, industry organizations in the UK, operating across Europe and in Asia. And essentially, we are here to help to drive a number of our community's agendas around open banking, financial crime, financial inclusion, and regulation, and cross-border finance. And so, it's great to be here to have a chance to hear from some of the experts as to what this might imply.
Thanks, Tony. Thanks everyone for introducing yourselves. And now just a few points of order. I mean, we have a number of questions that we will be asking to our panelists for their opinion and thoughts. And along the way, if you guys have any questions that you would like to ask, please send them in the comments and we'll try to address them as soon as possible. And I would like to pass you on to Mike, who will be moderating the questions going forward. Mike?
Thank you, Eva. Good afternoon, everyone. My name is Mike Pepple. I'm the CEO of Paynetics UK. And it's my pleasure to be posing the questions to our panel this afternoon. So without any kind of further ado, let's press straight on. Our first question today is, what are the key market factors driving the growth of embedded finance? Let me ask Tony to lead this. Tony, with your experience in forming the EPA many years ago and now rebranded to the Payments Association, you must keep a really close eye on what's driving the industry and the market forces driving embedded finance. So perhaps you could share your views with us.
Sure. Well, the good news, of course, is that this is new and exciting. The bad news is that the underlying drivers are the same as they have been for many, many years behind innovation in our industry. There's three of them, three categories, if you like. The first, of course, is changing consumer needs. This is how people's requirements and the problems that need to be solved using payments are changing as time goes on. The second category, of course, is technological innovation. And the third is regulation. And it's a wonderful bringing together of those three components that makes payments such an extraordinarily brilliant, fast-moving, fast-changing sector. Without one of those three, it would not be able to do that change as fast. But if you look under a little bit deeper, and I'm sure the others will bring some specific examples, the sort of changes we're seeing in terms of underlying consumer drivers are, relate from, the consumer's need for increasing convenience, optimized friction, that doesn't necessarily mean no friction, instant access to both information about the payment and confirmation the payment's taken place as well as it actually taken place, and then of course added value, which the extra bit of data and insight enables you to have if you embed your payment component within some other device. But we've also got some other clouds of change happening around, for example, the shift towards the battle between the schemes and the big merchants, Amazon and Visa. We've seen that that's going to have a big impact on how this all works. We're seeing, increased adoption of course, contactless, but yes, wearable technologies as well. It's no longer rather sadly brings a smile to the face of the person at the point of sale when I highlight my K wearables ring and pay in a wearable fashion. But we're also seeing the sort of the consumer impact of changing nature of the political environment around UK and EU in particular. I think if we then look at what's the technologies that's driving this, well, underlying this is the open finance ecosystem and the plug and play API enabled technology that makes all this possible, backed up by big bodies of technology, of computing power, machine learning and artificial intelligence. These are two terms that get rattled off the tongue in the same sentence quite often, but they are of course different. We bring into that the possibility of a digital identity that enables some of these transactions to take place. And then we throw in a regulator that is actually looking to change the underlying transaction platform. And what we've got is a real cauldron of change and a great mix of opportunity for technology innovators. If you were to ask me the question, are you asking the question later on, Mike, about whether we in fact are in a bubble or a shift?
Yeah, we are going to. That's going to be our final question.
Oh, very good.
Answer that one now.
Oh, so no, I don't want. I won't answer it now. Very good. Far away. So yeah, those are the three underlying drivers.
Yeah. So I take from that, it's kind of not one thing. It's a whole bunch of things coming together. I mean, Alex, you've got huge experience in working in Weaver, helping organisations build innovative solutions. What do you see their drivers in the growth of embedded finance?
Yes, I think there's a really big value story in embedded finance. The story isn't new, and the first example I know of embedded finance happened in 1919, right, with the introduction of car finance by the Ford Motor Company. But if you think about the value story, or even in that very early example, you've got somebody going in to buy a car, and the car dealer tells them that's the car you can afford, and that's the car you can afford with finance. So already there's the ability for the customer, the consumer, to have more choice thanks to financial service. Obviously, the car dealer gets to sell more cars, and the lender gets to acquire customers for their loans very, very efficiently. So we can see that sort of three-way value story happen even at the very sort of first examples of embedded finance. Now, fast forward many years later, and you think about what's happening with in today's digital world, and you can see some of the same drivers. So take, for example, if you are running a B2B SaaS business, let's say to manage restaurants, right? So your customers are restaurant owners who want to use your B2B SaaS platform to organize their menus, organize the staff roster, organize their stock maybe. And now you want to integrate banking for these restaurant owners. So you want to offer them a way to be able to pay their staff, maybe to handle tips electronically, maybe to receive payments from diners, to pay your suppliers, maybe to get some working capital on the back of the fact that the SaaS platform knows how good your restaurant is. That's an example which is much more contemporary, a B2B SaaS with embedded banking for restaurant owners. But the same value story applies exactly in the same way. The restaurant owner gets the efficiency of not having to key in lots of data to convince their bank manager to give them a loan. They get all of the money management systems integrated into their SaaS platform. Of course, the SaaS business has a great value story. They will acquire more restaurant owners, more customers, because they have a better value to them, but they also monetize better. The financial service is a source of incremental income for the SaaS business. And finally, they get much more stickiness as well. So they have less churn in their platform. And of course, the financial service providers, they're also making money from that arrangement. So it's a win-win-win equation. And that is basically, it's such a powerful thing that together with the enablers that Tony has been talking about earlier, this is what's setting the scene for this, this sort of wall of demand that we're seeing. And we're seeing this year, at Weaver. There's a wall of demand for embedded finance to take these principles and actually make them happen in the marketplace.
Again, it's fascinating how a number of things are coming together, and sort of the sum is more than the parts themselves. Andrea, I know in Rothschilds, you guys do some incredibly detailed analysis of the markets. Perhaps, you could share your view on what the market drivers are. And the question I'd ask is that a kind of Western Europe, or is that a broader global type trends?
Well, thanks for the question. And I come obviously from a slightly different perspective, focusing on the M&A. I think this is an incredible market in the sense that there is a strong demand from people that want financial service from brands that they know very well. That's a completely game changer, because people are not longer recognizing the bank as the place where they want to get some services, or the insurance company. They simply want to get a simple product from a brand that they know very well. And that's something that applies to, I mean, it's globally, it's not only Europe. It's something that, I mean, we're seeing in US, even more in Asia, where obviously there is a huge demand. And because here we are cross-selling client base, what is really important is having companies that can have a loyal client base. And what you want is to get money out of this loyal client base. The overall market is probably, I don't know, it's very difficult to quantify. There are different researches, but it's probably, I don't know, close to 20 billion. But the expectation is that in 3-4 years, it will go to 200 billion. So there is a huge potential of cross-selling different products. Payments is the easy example because it's the one that is picking up where there is an easy benefit for everyone. But obviously, asset management, consumer finance, and insurance will follow the same logic. I was very intrigued by the example Alex was making because 15 years ago, probably one of my first transactions was a joint venture between Crédit Agricole and Fiat, whereby Crédit Agricole was really keen to cross-sell consumer credit finance on the Fiat client base when they were buying a car. And that's exactly the same principle, if you want. It's just amplified by the fact that technology is making much easier to sell in this kind of product. And therefore, the trick is really having a technology that can make the customer empowered to do quick decision, but also simplification of product. Because what you want is to make sure that you are not let's say, overcomplicated the decision of the client, which has been in the past one of the main issues why only banks or insurance were able to sell product to some clients. Obviously, I think, and that's probably something that we'll debate later, regulation will be one of the key challenges for the future that can change the dynamic, but can also help in order to make sure that the embedded finance driver for the growth outside the pure financial market.
That's brilliant. That's interesting. Well, that's a great segue into Alison. Alison, I mean, I personally think regulation has been one of the drivers behind opening up the markets, and particularly some of the regulators have set themselves the challenge of actually helping the industry develop. Would you say regulation has generally been a force for market growth and will continue to be so?
I think we can see from the experience in Europe more broadly that certainly the Payment Service Directive did what it was meant to do, which was to open the market to competition by bringing firms into regulation, creating the confidence for consumers that that the services that they would receive would at least meet the same sort of minimum standards and expectations. And again, with the second iteration of the Payment Service Directive, again, we've seen increased opportunities. But regulation, is a framework. It's there's very definitely rules that will restrict and constrain what firms can do. And I think what's important to recognise is that as Andrea was saying, this is about bringing brands. Enabling customers to be able to take simple financial services from brands that they already know and trust. But again, we're bringing together people who are not necessarily normally in financial services, and combining them with the rules and requirements of regulated financial services and the expectations. And over the past number of years, we've seen an increased scrutiny, particularly in the payment sector. I think we'll all recognise that in the UK, that there's more obligations of being applied by the FCA, and indeed the FCA is scrutinising to more depth, which has got to be good for the overall sector, but it does mean that standards have to be lifted, which also creates difficulties for firms coming in with very innovative ideas. We quite often will speak to firms who say, well, we just want to do it this way. And the answer is going to be, yes, but it just doesn't fit into the regulatory framework. You're not going to be able to do it the way you want to do it. And actually what that boils down to is it's about costs. The way to do it right, according to the regulations, is just too costly, which, you know, unfortunately for those firms, changes the cost profile for their business model.
Yeah, it's interesting. A sort of
Mike, if I may interrupt, sorry, Alison, just a quick follow-up question on this one, because it's, I mean, that's one of the key areas where there is a kind of inherent conflict in the embedded finance space, because on one side, consumers want everything to be at somewhere they don't see it. I mean, what we call seamless. I mean, they don't want to see the card, they don't want to see the bank account, they just want to buy whatever they need to buy, right? I mean, they don't, and that's part of this overall shifting of loyalty from financial institutions to brands and experiences. But at the same time, this is a very regulated business, right? I mean, the technology is there, and technology makes it possible to embed these kind of products with the tokenization and digitalization, etc. But at the same time, the regulation is a super regulated activity, not surprisingly, because you deal with other people's money. How do you see this one going forward? I mean, this kind of, what is the view of the regulator to make this one a constructive conflict rather than being an obstacle in moving forward with the embedded finance trend?
I think it's always going to be a matter of tension, isn't it? You know, and that's probably the right place for it to be, you know, both sides pulling and straining to make the tent stand up properly. There are definitely, you know, increased obligations coming down. I mean, just yesterday, the FCA published a further consultation on a consumer duty, where all regulated financial service firms will have to put the consumer first. I would imagine most firms think that they are putting the consumers first, but nonetheless, the FCA are seeing examples where the firms haven't done right by consumers or particular tranches of consumers, and that's always going to be something that you know, increases difficulties. It's a sunk cost investment, isn't it, for a startup firm that's wanting to get into business, to get started, but yet they have to come back to the beginning of the process and build from the ground up recognition of the vast array of consumers and potential issues that they may face. And there's no way around that. That's just the rules. That's the framework in which we're working.
Thank you.
Can I ask you a question, in the sense that I think one of the main risks is that the regulation will follow some other example. If I take the asset management, the story in the past was that as long as I'm extremely good in managing money, or I'm being very successful, I'm able to charge very good fees to client. And as long as the net, if you want, is better than competitor, then the client will not see what the embedded cost is in my overall product. Then with MiFID, obviously transparency is becoming the mantra, and all the asset manager has been forced to make a clear distinction of what was the overall benefit for the client of service, but also highlighting all the different costs. Just created obviously a change in the behavior of some clients, because they were not really willing to pay higher fee if the service of the quality was not proven by some of the providers. I mean, do you think that this kind of approach can potentially affect the embedded finance, and therefore an increase of regulation might also increase the request of transparency and split of overall cost and benefit between all the different stakeholders?
Sorry, Andrea, was that for me?
I think it was.
Yeah, yeah, look, it very much feels like the trajectory here is that there's going to be increased scrutiny, increased attention and focus. The pandemic brought that out to the fore, with some firms showing great initiative and innovation, being able to change and adapt to consumers' needs, and other firms not meeting the right point. Even looking at the buy now, pay later market base, you know, outside of regulation at the moment, but of course we're looking to see whether it can be brought in, and in order to protect consumers on the one hand, creating an environment where opportunities for people who are going to buy whatever it is that they need, but they can do it through this system without going to payday lenders and therefore getting a much better deal. But nonetheless, then there's a raft of other concerns that will arise. So, I mean, it's the regulators' challenge to always be able to justify what the measures that they're bringing in, and for firms to be able to work out how to apply it in a commercially viable way. That is the challenge that's always going to be faced. And the more complicated that we make the services and the more players that are involved, then the more detail that needs to be gone into for firms. And unfortunately, I think it's a reality that there are, when firms start out, and particularly if they're not coming from a financial services background, they're coming from an entrepreneurial spirit, and they've got great ideas of what they're going to do and how they could do it. The realities of working in a regulated environment can come as a bit of a shock.
It certainly feels to me as though we've, the regulator, certainly in the UK anyway, is kind of saying to the industry, okay, I've kind of give you kind of a light touch environment, but it's kind of now time to grow up, and growing up means that we need to raise the standards and raise the bar, which I do agree. I think in the long term will be a good thing for the industry. It may not feel like it on the journey. Well, look, perhaps let's kind of go down a layer and maybe move on to our second question, which is about which sectors have adopted embedded finance, which have kind of led the way. Are there some great examples out there that we can follow? And what can we do to get other sectors involved in embedded finance and give customers even more innovation and better propositions? Alex, maybe I could ask you to lead this one. You've probably got a vast experience in Weaver of delivering some of the most innovative solutions in the market. Perhaps you can give us some insight into which sectors you believe have led the way.
Sure. Actually, earlier this year, we did a study of service sectors. By that I mean the traditional sectors that are things like healthcare, education, logistics, transportation, retail, leisure, and we looked at the size of each market for the potential size of application of embedded finance in each of these markets. And then we looked at their readiness. And one big sort of factor of readiness is how quickly are they digitizing. And you can see a good indicator of how quickly they're digitizing by the amount of VC money that's going into that sector, typically backing disruptors, digital disruptors. And we ended up doing a deep dive into 29 service sectors, including logistics, transportation, retail, leisure, travel, a whole bunch of them. And the ones that stood out most to us were four. They were the future of work, because so much digital transformation is happening in the future of work. And of course, the whole gig economy, which started, which has been going on for a decade now. But with the sort of COVID situation, it's actually created this cauldron of innovation and digitization of the way we now conduct our work life. And so that's an area that I think is hugely ripe for embedded finance. And you can start to see a whole range of services. For example, if you take something like payday loans, which were kind of bête noire, if you like, of in a way of politicians and regulators, they've been supplanted by a new breed of embedded finance, where companies, employers themselves, participate with payroll management systems to be able to provide early wage advance, for example, as part of a kind of joined up way between the employer having the data on what they're going to be paying that employee, and then liquidity providers that can provide the part of the salary ahead of time to help help employees manage cash flow, as an example. So that is really one big area. The future of work is a really, really huge area for embedded finance, and it's happening right now. The second sector, which in a way also has been very transformed by the necessities of lockdowns, is the education sector. As schools had to scramble to teach their students and their pupils online, then you had suddenly the way of delivering education got shifted by maybe even as much as a decade of change in user behavior, where these online platforms for education, which have existed for a while, suddenly became, you know, a mainstream way by which sort of people get trained and educated. And there you've got some really interesting flows of money. You've got content providers that want to get paid for their content. You've got tutors that want to get paid for their time, you know, FaceTime with students, and you've got, you know, students wanting to pay for this, or having to pay for the education services that they're receiving. And for the larger courses, maybe a university degree or a certificate diploma, they might actually want to be able to split that payment over many installments, for instance. So handling all of these quite sort of complex multi-way payments is a really huge opportunity for the online education, basically, you know, industry. So health education are two big ones. Future of work, and finally, we also see that that the property, prop tech is another area which has basically huge potential for embedded finance. Again, the digitization of rent, for example, of managing properties, has been happening for a while. Huge opportunities to be able to provide financial services, whether that's lending, whether that's ways of splitting a cost amongst, for example, members of a condominium. Again, plenty of opportunities for financial services to be integrated into these digital platforms for managing property and real estate. So those were the four that really stood out for us.
Yeah, I find it really fascinating as a sort of proxy for readiness, the amount of VC money running into that market, which must give Andrea a really good insight into what's coming down the track. So, Andrea, would you agree with that?
Oh, I fully agree. And I also completely agree with the assessment that Alex was making, in the sense that, to me, everything is really driven by technology. I think it's technology and also probably age and behavior of the final client base, because that's what you are cross-selling. And again, I think there is a lot, which obviously is the obvious one, but I think there is a huge potential on also other financial products like potential insurance or small loans, where again, once you get people used to see brand and not the bank as the key provider of these services, then obviously, I mean, you can cross-sell a bit everything, as long as you have the platform and as long as you have the credibility in order to be the trusted provider for each one of the client. Yes, VC are obviously looking at this market because it's intermediating the bank might become one of the best way in order to go back to the profitability that bank had, I don't know, 20 years ago, where the ROE was 25 and 30%, the regulation was much lower, focusing on the product that really make the money rather than the one that made the loss for all the banks over the last 10 years.
Yeah, that's interesting. I mean, with new sectors coming into this market, I guess one of the first things they must worry about is how will regulation impact them. So, I mean, Alison, do you see a lot of inquiries coming from areas that we wouldn't normally assume with sort of fintech type development?
There's certainly a great deal of development. I think Alex has mentioned some of the key ones that are bubbling away at the moment. The thing with getting into the regulated sectors, I sort of feel like I might possibly be on the verge of labouring to death, is just, you know, it significantly increases your cost because you're going to have so many more obligations, and that's why it's so much better to go with a supplier who's already involved in there, to start slow, to start in that sort of safe environment of working with another provider who can already meet those obligations because they're geared up to do it. I think the regulatory framework will create a great framework. It opens up confidence and the playing field, but unless you need to go in knowing what it is that you're doing and what is going to be expected of you. The firms that come, the sort of very enthusiastic entrepreneurs that come with very little background from regulatory and an understanding of that will probably get lost in this process unless they have very good advisors at their side and the key people right at the middle of the business who can keep them right and on track as they build the business.
Yeah, I would certainly, what we find is that a lot of people come to us from outside financial services, and one of the attributes that they want us to bring through embedded finance is to look at the regulation and make sure they keep them safe. Tony, it's almost the raison d'etre of what was the EPA, now is the PA, to help encourage people to come into the market and use payments. I mean, what's your view of the sectors that we have seen come into the market and are yet to come in?
Well, I think it's very exciting that people are really realizing that actually payments is where the money is, and that if you enable the transaction, then you can deliver benefit to all sorts of people, including the people whose products and services are being embedded within. So I think it's a great thing. I think there's an underlying concern we have to all take account of, though, and that's that if we're not careful, we end up with people who are really on the fringe of, on the edge of our industry, adopting a desire to become payments companies without, as Alison says, essentially the qualifications or understanding of knowing what that implies. It's quite interesting. I was chatting to the FCA's head of authorization the other day, and it's a brilliant conversation because she essentially said, look, we have a collective problem here, which is we're bringing all these new people in. It's great, but many of them are just not knowing how to submit a good application for a license, basic stuff, whether it's open banking related or e-money related, or more than that, or even a payment institution. And as a result, there's this great backlog of applications which are either incomplete or inadequate or incorrect, which then ends up with a very long process to actually get them authorized. Now, what she essentially said to me, and I think we'll all be up for this, is the regulator saying, let's help you to help us, to help you to help us. Let's get some ways of helping people who are on the fringe, and there's going to be more and more of them, to understand what it actually takes. And then once they're authorized, that's when Maha Eldamachki, who's at the PSR now, I think, she's at the FCA, she's setting up these early stage sandboxes. These are for people who have just become regulated and helping them to learn what it's like to be a regulated institution. And then once they're on a fast growth track, to work out how to continue to be compliant as they grow and their organization encounters all those stresses and strains. And Alex, you've been involved with fast growing businesses over the years, many, many times, serial entrepreneur, if ever I saw one. And the sort of requirement at the base level, when you've just got a dozen people and when you've got 1,200 or 12,000, is very, very different. So I think the regulator is owning this problem. I think our industry has to respond positively and go and actually say, yes, well, we're up for this. And let's ensure the embedded finance opportunities can be enabled and capitalized on, and not have the regulator getting in the way and saying, please stop.
That's interesting. Eva, what if I can come to you here, what's your perspective of this?
Well, actually, I see that Alex from the audience has asked a very interesting question. So maybe we turn it around and ask our panelists to comment on it. And it's, I guess what Alex is asking is whether and how we see the role of embedded finance in the broader social purpose credit scoring concept, and especially if we move away. Well, we don't even need to move away from Western Europe or Europe in terms of how the embedded finance can help inclusion into the financial sector, because I think all the panelists touched upon this point from different angles. And as the technology develops going forward, would that help with a better inclusion, or would that create additional barriers for certain parts of the society to miss on this whole trend? I mean, maybe Alex, maybe you could sort of shed some light on this one, given that you've done a lot of research and a lot of work on.
Sure. No, I think it really does. We think about when we talk about financial inclusion, we often think, how can we create a bank account for the unbanked? But it's actually much more than that. Financial services often help us do things that none of us buy financial services for their own sake. You don't buy a mortgage because you collect mortgages, right? You buy a mortgage because you want to be able to afford a house that you couldn't otherwise afford without a mortgage. So when we talk about financial inclusion, one of the biggest barriers to financial inclusion is basically being educated about what financial services can do for you. And at the moment, let's take to go beyond payments, let's take investment. We all know we're better off if we're able to save and have our savings, acquire more value over time. But many people aren't sophisticated enough to know how to do this and to really not get ripped off. So that excludes a whole bunch of people from having the benefits of savings and investments. Now, what applications can do, what contextual applications can do in embedded finance is they can make it meaningful and relevant to a particular segment of customers. I'll give one example how this also has the effect of being really beneficial for the industry. If you take one financial service, insurance, mobile phone insurance didn't exist as a category in insurance until it started to be bundled with mobile phone contracts. Once it became part of mobile phone contracts that you could opt for the insurance, then it actually created a new category. Now, that arguably benefits people who want to have the security of knowing that when they lose the phone or get it stolen, they will actually be able to have that safety. But it's also created a whole new segment in the insurance industry for mobile phone insurance. So it also increased the size of the pie, if you like. And I think embedded finance can be a really powerful force in making these sort of obscure financial services that people wouldn't go out of their way to buy into something which is much more easy to consume because it's so much in context. And that, I think, is the real power of embedded finance for financial inclusion. It's a really great new idea how to reach parts of society that financial services has struggled for many, many decades to be able to reach.
Thanks, Alex. And if we move from this point to look at kind of a more macro level, how the industry is going to change, because as you rightly said, I mean, there's a lot of verticals where their sort of readiness is increasing, and there'll be more and more verticals coming on stream, ready to be disrupted, digitized, and happy to embed finance. So from a kind of sector perspective, Andrea, who do you think would the losers be? Because once you start moving this kind of payments and financial services to be embedded within non-financial ecosystem, obviously you may be increasing the pie as a whole because of inclusion and new products and new services, but definitely there'll be a redistribution of the pie inside. So how do you see we kind of see who the winners might be, but who do you think the losers would be?
Yeah, no, I think there are two main drivers. So first of all, the market will massively increase. As I was mentioning in the beginning, currently is probably 20 billion, is expected to become 200. The bulk is and will remain payments. But I fully agree with what Alex was mentioning. Insurance, it's a great example of how you can improve financial inclusion, and you can also overall widening the overall product offering for embedded finance. I think it would be the same for asset management and consumer finance. So most probably payment will remain the bulk of the overall market. But I think other product and vertical will help in growing the overall market. Loser, I think, will be the one that are not able to neither cross-sell their client base in terms of technology. So if I look at some of the banks, obviously they are struggling, for example, in being competitive, because despite they have a loyal client base, they are very complicated. If you have some banking account, you can see that, I don't know, buying a fund that should be super easy. And if you have a Revolut account, it's something that you can do in a second. It takes ages if you are in HSBC, for example. So I think there is obviously a trend that will impose also to traditional players to think about becoming competitive. At the same time, I think regulation will need to make sure that giving access to everyone to some market and instrument will also protect people that have not a full understanding of what they're buying. So if I make an example, now crypto is becoming available to everyone. It doesn't mean that everyone has a clear understanding of what does it mean in terms of risk and investing in cryptocurrency. So I think it's important that this service will become available to everyone. And I fully agree, financial inclusion is a key driver for embedded finance. We need also to make sure that people will have a clear understanding of what does it mean buying an insurance, buying a loan or a mortgage in order to avoid mis-selling in the future.
Thanks, Andrea.
Thank you. Well, I'm kind of interested. Let's just develop this point a little further, because we've sort of drifted on to the, how significant is the customer demand for non-traditional banking services? And Andrea there sort of gave us a kind of one view. Tony, let me just come to you a moment. In terms of, what drives it? Is it the customer demand, or is it really innovative product proposition?
Well, what's interesting for me is this is a lovely example of the time is just right for this. There's a number of different pieces in the jigsaw that needed to come together. And without one of them, then none of this embedded finance would happen. But as a result, the thing that's driving it, of course, is the potential pool of profit, the potential profit pool. And the wonderful thing about markets and capitalism, I love them or hate them, they do collect around those profit pools entrepreneurs interested in doing new business that will help them to satisfy their various stakeholders. It's because particularly our ecosystem is so full of creative, entrepreneurial, driven business people who have spotted the profit. They can smell the money. And as a result, maybe a few years ago, embedded finance was simply not possible. But it's because we have organizations like yours, Mike, who are actually coming together and enabling this sort of thing to happen, that is the reason why it's actually happening. Without those things, people would be saying, well, wouldn't it be nice if I could have mile related charging on my rental car that's automated within the rental agreement, but that doesn't require me to get out my card to pay for it at the end of it. Wouldn't that be nice? Well, yes, it would. It's only possible now, so now we're doing it. It's always been a demand. It's just only now we can do it, I believe.
That's interesting. And Alison, do you think that's very much where the regulator wants us to look? Get more sensitive around what customers really want?
The focus is very definitely on what the customers want, but also whether what we offer actually genuinely does meet their needs. The phone insurance example is a good one. The crypto mentioned there is another good one. These are examples where the products may be useful, but they're being offered at a point on the insurance point, at a point of time when the customer is actually buying something else and looking, are they making the right decision at the time? I was doing some pre-Christmas cleaning out the other weekend and came across a receipt for a lovely bracelet that I bought a couple of years ago. But along with that, there was some insurance with it, which had obviously just expired by the time I was looking at the receipt. Not that I needed it, and I felt sad for the person who'd got me that bracelet. Now the insurance, it wasn't particularly expensive, the insurance, that was, the bracelet was, of course, but it's an example of where potentially consumers are being encouraged, pushed, not necessarily pushed, but encouraged down a line that's not necessarily of the best value for them. And that's where the regulator's attention is very definitely focused, and where any aspiring business person should also be paying attention to. The crypto example is a great one as well. We know that the FCA has, again, to Tony's point, been inundated with applications because all the crypto asset businesses based in the UK have had to get registered with the FCA, and so there has been a huge number of applications, and the FCA has processed them very, very slowly, speeding up now. But the one of the key things that they're looking in there at is, how well are customers understanding what product they're being offered, And where, for instance, e-money institutions come alongside a crypto authorization, is it clear to the customer when they're in the regulated space of the e-money, and when they're in just the non-regulated space, which is, of course, the crypto bit. But it also has interesting implications for businesses as well, because the Financial Ombudsman Service has a pretty broad-reaching jurisdiction, and they tend to think of these other services that sit alongside the regulated service as also being part of their remit. So there could well be interesting cases where firms that are offering other services that are not regulated find themselves handling a complaint with the Financial Ombudsman Service on those particular areas, simply because it's been associated with a regulated financial service.
That's interesting. Andrea, did you want to make a comment there?
Yeah, to me, another key driver is really the product simplification, because that's what clients are looking at. You think on insurance, for example, you buy a watch, you want to have protection for your watch. If you can have it in a simple way, when you buy, when you are at the retailer, many clients will accept it. If you need to go home, you need to go on the website, you need to discover which one is the best one. Well, then it becomes very complicated. It takes a lot of time. People are looking for something which is simple, they can have quick and immediate access, and is properly priced. So that's for me one of the key drivers for those products. In the past, there was a lot of competition, and people thought that having complicated product, but bespoke product was the best way in order to have loyal customer and get access to a new client base. Now I think many are realizing that what clients are looking for is something which is standard, which is simple, well priced, but at the same time that they can get with a limited effort and potentially using technology rather than going in person somewhere.
That's interesting, because it almost feels like the proposition gets ahead of the customer, and until the proposition is made, the customer doesn't realize that's a requirement. Maybe Alex, you're developing lots of different types of solution. What do you think leads? Is it the product innovation, or is it customer demand?
Well, I mean, the best products and services are the ones we didn't know we needed, and then we can't live without when we experience them, right? So these are the, you know, just to mention a few, the iPhone is a great example of that. But also more recently, if you think about Uber as an example, that, you know, making the experience so seamless of getting from A to B that it completely changed the customer expectations of what they expect from any sort of taxi company, if you like. So we all repeatedly, the more successful embedded finance examples that we see out there are the ones that start with a customer need. And typically you've got multiple factors in a customer need. You've got data. You need to use data to help the customer without the customer having to think too much or get informed too much. You've got the ability to automate the financial service, so they don't have to get out of your application to be able to go to make the payment or get the loan or get the insurance product. And when they combine the application in the domain, in the case of Uber, is getting from A to B, right, or hailing a cab, and then the financial services within it and the data that makes the whole thing in context and meeting that customer need. It has it looks like magic, right? It has the effect of delighting the customer beyond what they had been even anticipating. And that's when you get these blockbuster products like, like Uber, like Airbnb, and many of those that have not just given customers what customers have said they wanted, but have shown customers what is possible and have delighted customers. And embedded finance is not the whole answer to this, but it's actually a very, very powerful factor in creating these kinds of propositions.
That's interesting. Tony, you've got some thoughts, I think.
Yes, I just think it's worth pausing for a moment and being aware that this requires a very high degree of trust by the consumer, that when they embark on a customer experience, whatever it is that they're buying or using or encountering or whatever it is, that actually they know that what they get to pay for or what they have as a result of or alongside the core purchase, might be insurance, for example, or access, or information, or some sort of added value, that they know that that's what they're going to get. Because if I have a £10 note and I go and give it to somebody, I know that there's a trusted counterparty that I'm dealing with. If it's with an entity or an organization that is some amorphous mass that I don't know and don't trust, I won't embark on that purchase decision unless I'm completely confident that the value that's being delivered is clear and understandable and transparent. So we, again, have to be careful that it's not just the big organizations with deep marketing pockets that can build a wonderful trusted brand that benefit from these new innovations. We've got to find a way of ensuring that there are no opportunities for the media to sneak in the back and discover that actually not all gift cards can be redeemed within a year of their purchases, for example.
Yeah, we need an embedded finance guarantee, maybe, Tony.
Yeah, maybe we have a charter, an embedded finance charter, for goodness sake, or something which is a kind of a collective statement to the market as to what acceptable and appropriate practices might be, but something that says this is the standard. I don't know. What do we think?
Ivo?
I mean, just a thought from my side. I mean, obviously, the exponential growth of embedded finance is definitely driven by the consumer demand, and I fully agree with Alex that it's kind of a virtuous circle. I mean, the more you show to the consumer, the more they demand on the other side. So this is kind of driving the whole industry. But there is another aspect which is not just purely convenience related. I think based on the completely new platform and the technology, this allows for a new relationship between the consumer and the merchant, or the service provider, or the employer, or whatever the entity embedding the finance is. Using the transaction data, for example, you can go to completely new relationship and sort of enrich this communication between the consumer and the merchant. Because when you think about it, if you just use your card and you go and buy whatever you buy in the shop, the transaction is lost, right? I mean, there is no follow-up between the consumer and the merchant. If you embed this one into a certain ecosystem where it's going to be a wallet or a loyalty system or whatnot, then all of a sudden both sides of the equation start to benefit substantially, because the consumer start to get much more tailor-made offers, for example, or vouchers or information, and the merchant starts to understand much better the consumer, and therefore they can much better tailor-make their product or offering and whatnot. So it's not only the convenience dimension, it's also changing or enriching rather the relationship between the consumer and whoever the other side is, whether it's going to be the merchant or service provider, or even the employer in the case of the employee benefit embedded finance solutions out there.
That's interesting, because that kind of suggests a little bit like the big brands that maybe not traditionally associated with providing financial services. There's a big opportunity for them because they're pretty much already trusted by the consumers. I mean, Alex, are you seeing anything in that area?
Yes, but it's very embryonic with the big brands doing, embedded finance. I mean, we all know the Amazon one-click, right? So that's what most, I think, online retailers sort of see as the gold standard. But if you go slightly outside that arrangement, then the bigger brands, which have the huge opportunity to really bring customers in large numbers to adopt embedded finance, I think they are still, they're still sort of behind the curve, if you like, in terms of being more adventurous. So at the moment, in the state of the art in embedded finance is that it's the digital disruptors who are coming into the market using embedded finance as a competitive wedge to be, to kind of go against the incumbents. What I think will happen, and in a way, buy now, pay later is a good example of what can happen once something really catches fire, is that once the digital disruptors show what's possible, then there will be the fast followers who will pick up on the successes and will go and emulate them, right? I don't think we're seeing too many of those. There's pockets like buy now, pay later would be a good example, but and that's I guess that shouldn't be surprising. Any kind of new Any new approach of doing things starts typically with somebody who's maverick, who's looking to change things. And then once it's successful, everybody wants to jump on the bandwagon and have a piece of that. But we're early in the embedded finance journey. And that's why when we talk about, is it overhyped? Is it a bubble? I think it's actually at the very early stages of a trend that will take a decade to run, because it's that we're in that phase of an emerging new way of doing things.
That's interesting. Well, that sort of brings us on to quite neatly onto our fourth question, which is around, what are some of the regulatory and data sharing concerns that could slow down the adoption of embedded finance? Alison, I think this is particularly relevant, and I know Alex mentioned buy now, pay later there. How do you see the regulatory environment changing, and particularly maybe if you could comment on buy now, pay later, I think that would be very useful.
Well, as we've mentioned before, the regulatory environment is very much driven, of course, by the rules, but also the approach of the regulator. And certainly in many of the sectors that we've been talking about now, the regulator in the UK is seizing its opportunity to stretch its muscles now that it's released from the confines of Europe, and we're looking to see how rules will change and things will grow, and the developments and the opportunities. I think in the FCA we have a relatively receptive and helpful regulator, but of course there are difficulties and have been difficulties, particularly as was mentioned before, for instance, even just in the adoption, the authorization process in terms of helping firms get into the regulated sector. There's been issues there, but the confines of the regulation and the data sharing concerns, the rules are very definitely there for the protecting of consumers, and again looking towards the new regimes that are coming in terms of the consumer protection duty and the operational resilience requirements. These are going to be things that require firms to spend fairly significant amounts of resource, whether that's mainly with internal staff time or indeed some external changes and upgrading of technology and the like, to ensure that they have met those obligations and the FCA's expectations. And so, we're in a situation where, again, we go back to the tension. It's the tension between very much constraining and the excesses of services that are going to end up taking consumers down a track that they shouldn't be going, and the opportunities and creating a welcoming and innovative environment within the UK for businesses. Your question about buy now, pay later is an interesting one, because of course it's subject to consultation at present. There are both sides on the question of whether it should be brought into regulation, but it's likely that that's the trajectory we're going on.
I think that's extremely likely. I know Tony, the Payment Association, is one of the big influencers around regulation. So what are your fears about regulation, and what could stop, or at least stall the industry?
Well, so look, Alison is definitely the subject matter expert here. So, but I'll tell you what I'm most concerned about of all of the breaking waves of regulation that's coming down the line is this new consumer duty. I think this is creeping up on us. I think the industry is being caught out here. We put a pretty strongly worded response to the last consultation that essentially there's a few things. Now, Alison, I'm sure you can clarify me here. One of them is that you have to be responsible even if you're not a consumer-facing organization, you have to be responsible for the consumer-facing organization's compliance with the consumer duty regulations. And even if you're 1, 2, 3, or 5 steps back, and in payments, as we know, when you do a payments transaction using a credit card, you can go through 8, 9, 10, 12 different organizations. You still have to have responsibility for that. Now, the cost of that compliance, I just think is going to mushroom. Now, my word, I should be saying to my kids, get yourselves into the compliance industry, guys, because there's going to be a huge demand for smart young people coming through. In fact, I happen to know that a friend of my daughter's is currently interning with Alison's company. So I'm walking the talk here. But so I don't know whether, Alison, I'm right. I think this is a wave, and it's, Nikhil Rathi, new-ish CEO. He's been in the job a year. He wants to make good political capital out of the fact we are the people protecting the consumers. But if you're not careful, you end up with products and services that are either so cumbersome or so expensive that nobody wants them, or worse, so risky and so expensive to deliver that no investor will invest in the entrepreneur that's launching that product or service. And this wonderful thing is we can have consumers very, very well protected with no products and services to buy because nobody's selling them. And I think that's our biggest threat.
That's interesting. Alison, I'll give you a chance to come back on that one.
I think broadly, nobody's going to say that we shouldn't protect consumers' interests and have an understanding of how the consumers impacted. I mean, that's very much at the heart of what everybody has contributed on the panel today. But nonetheless, I think there is, the itch that the consumer duty is trying to scratch has not perhaps been as articulated as well as it could be, and that's what we're looking towards. We're on a trajectory here. Further consultation, legislation is going to come in, or not, rules are going to come in with an implementation period, ending in April 2023. That what we need to do is make sure that it's clear to firms where their obligations start and end, and how they can be managed in a sort of commercially viable way. Because you're absolutely right, there's no point in stifling a market for paperwork. It needs to show clear value.
Well, as someone who actually has to develop solutions, Alex, give me your thoughts on this.
Yeah, we're very conscious that by its nature, embedded finance is a scammer's paradise. And it's not that the technology doesn't exist. It's actually when customers have been told, don't share your password, don't. Lots of prohibitions around who to trust. And now in embedded finance, we're saying to them, well, here's a front-facing app on your mobile phone, and please give permission for that app to access your bank account, because that's the new way of the world. When consumers start to respond to that and start to see the success stories, they'll say, okay, it's okay now to start giving my my banking password to apps that are not from my bank. And that is basically what I think where the danger lies here, that consumers will be told a message which makes them much more vulnerable to being scammed. And as soon as that happens, regulators will basically come down very hard on the practices to make embedded finance safe. And I think it's in our interest, anyone who's involved in the embedded finance industry as it emerges, to try and preempt that situation and to actually tell regulators what the tools can be and what the education and what's the, what those, maybe even those sort of logos and guarantees that we jokingly talked about earlier to help consumers navigate their way into a new environment where they buy their financial services through a third-party application that's not a bank.
I mean, Tony and Alison talked a little bit about really some concerns which were a little maybe UK centric. Andrea, do you as an advisor and investor, do you think those concerns are across Europe and globally, or are we a little UK centric here?
No, absolutely. I think are global, not even Europe. The themes are always been the same, and I fully agree with what Tony said and also Alison. I think the change in the regulation will strongly affect the way all this opportunity will unfold, and also the overall profitability that potentially can bring to some of the companies. Because if you think about the banking system, again, 15 years ago, which was less regulated, showing an average ROE of 25-30%, and now obviously is pressed in high single digit. So I think the overall opportunity and the main concern for some of the investors is really how the regulation will unfold, transparency and also client protection. At the same time, it's simply an opportunity. It doesn't mean that it will reduce the potential of these sectors. It will simply change potentially the way this business will need to approach the ultimate client.
That's interesting. I mean, as a kind of advisor investor, do you take into account the attitude of a regulator in a market as part of the investment process?
Absolutely, absolutely. That's one of the key points, and also precedent and ability to have dialogue is one of the key elements. To be honest, it's usually just a matter of time, in the sense that the market is efficient, and therefore it's very difficult to have geographical areas that are not going in the same direction. It's simply taking a longer period just to adapt to what becomes the overall standard for the industry.
That's interesting. Alison, I shouldn't probably, this is an unfair question, but I'm going to ask it anyway. I mean, you know, with Brexit happening, with potential divergence between the UK and some of the European regulators, do you think that'll slow down the industry?
Carries the risk that firms, you know, what we've seen so far is that firms need to have both a UK and an EU presence. There's very few of the UK firms that just have remained UK and have folded their business back in. So in order to be successful, they need to have that cross Europe position, and it's very definitely complicated. It's additional costs. It's you know, additional rules, and of course, any divergence in the rules will just make systems more difficult, because you can't have the one system that fits all. Will have to be adapted by jurisdiction. So yes, it's likely to cause difficulties, but hopefully the gains made in some jurisdictions, because rules have been simplified or made easier, will, you know, still make it worthwhile. But, you know, because we don't want to hamper progress that way. But of course, where additional burdens come in, that will just add to complications.
Interesting. Tony, you sort of started this.
So look, I remember years ago, we did a set of comparisons between different markets in which companies that were licensed in the UK and passporting, a term we hardly hear used anymore, of course, because it no longer exists, passporting across Europe, and which jurisdiction they should go to. I've noticed two things lately. Of course, we've all seen in the FT and the Economist, the kind of the tussle or the battle going on, very big, important tectonic shifts of power across the continent of Europe for financial services. I think there's no question about equivalence. I think from everything I've read and the commentators I've listened to, it's pie in the sky. We're not going to get it. The Europeans don't need to. If they give the UK the permissions that they give us equivalence, then everybody will leave. That's all, by the way, don't quote me on that. And I know this is being recorded, but just to stretch a point. I think the other thing I've noticed is an increasing number of entities in Europe who are pitching to UK companies to have themselves based there as well. So Estonia and Latvia in particular, and Lithuania, these are countries that have said, look, actually, if we can use this as a means of bringing people, jobs, growing investment and taxes to be paid in their country. So they hear overtly. I was on the phone to the guys in Latvia saying, yeah, we want UK organizations to be based over there as well. And so it opens up opportunities. So I think divergence can be a good thing. We can then stop having to conform to some of the poor components. For example, GDPR. We do know that the government has already said we're going to drop some parts of GDPR. Good, probably good. Alison, do you agree? I mean, but you know, this is my thing. Is I think we have to say, look, we're outside now. Equivalence is not going to happen. We've got to capitalize on it by both investing in Europe appropriately, but also going our own way.
Wow, Alison, there's a big question.
Do we get rid of bits of GDPR? Well, there's so much legislation there, so many regulations. Where would we start? We could go through a range of them. I'm sure that in nearly every section we can find things that could be what's the word? Shifted out, reduced, minimized. It's a very broad question. I'm not going to be able to answer it in one go.
Alex, let me come to you here. You're challenged with trying to build apps that can be used on a global basis, never mind a regional basis. If there's no equivalence and there's divergence, is the era of a global app going away from us?
Well, you have to design for that. I mean, we think about Uber again. Uber didn't get taxi licenses around the world, right? I mean, they made do with what was in the ground, and they created a uniform experience across all of that. It's not easy, but if we wanted to create global platforms, then it is possible with more investment. I guess Europe was easy, right? Europe was easy, especially for UK fintechs, because they had a great regulator in the UK, and there was lots of investment, and then they could just basically go into the rest of Europe and not have to do much to be able to access the European market. Now the idea of equivalence, I agree with Tony, is simply not going to happen. So what's happening is that entrepreneurs are having to think about their UK business, they're thinking about their European business. We no longer talk about Europe, including the UK, when we talk to investors. We talk about, we're doing this in the UK market, we're doing this in the European market, and we don't expect, and we do expect to have to make adaptation for that market. Now, that is a barrier. That is a real barrier. But if you want to do things globally, then it's also your proving ground for how do I cope with this, with this sort of variety of environment in the UK and in the most neighborly region that's worth being in, right? Europe for UK entrepreneurs. And then if we can get those right, then it's not a huge step to think about how do we get the US right? How do we get key markets in Asia right? So it depends. If you want to do something easy, then it's a really bad change of circumstances, I'm afraid. But if you want to build a global business, maybe there's an opportunity there to use Europe as a stepping stone into a global launchpad.
Sorry, I was just going to say we're looking at that from a firm's perspective. I wonder if it really makes much of a difference for consumers. I can see that some will travel, and certainly being able to use Uber anywhere in the world and having the same experience is useful for those of us who maybe in the olden days who were able to travel, but does it really matter for the customers?
That's a really good point. Our customers more domestically orientated, or that's going to be a key question, I guess, in the development of businesses and the development of embedded finance.
To go back to what Alex said, I think it's an interesting point, because if we look at the embedded finance being driven by global brands predominantly, right? Sort of companies that have access to a large customer base, pretty much by definition, they want to have the solution across borders. Very rarely you would have a player that will just stay in one market. So the ability to serve cross-border in different markets becomes kind of a mandatory, both in terms of how you design the flows and also how you sort of comply with the regulatory regimes. And there is for sure that the UK and continental Europe are going to be diverging probably in terms of regulations and requirements. So that's that kind of part and parcel of the whole embedded finance philosophy, because you need to be able to scale cross-border. Otherwise, half of the job.
Mike, I think it complicates things a little bit. I just imagine we've got a Mercedes, and you're trying to buy the new Wizzy S-Class electronic Mercedes or whatever, and you want to buy it out of Germany, and you know that you've got to pay per use lease, so it's not based on months, it's based on miles, and it's based on, I don't know how many people you've got in your car, and the more people per car you've got, the more you pay, for example. When they come and sell it in the UK, they've not only got to do a left-hand drive, they've also got to do a new issuer. So, I mean, how ridiculous would that be? We've got a different issuer in a different country. Well, of course, you know, there was a day when that wasn't necessary. Now it will be. So I'm sure there's lots of other use cases like that, which will be complicated by the lack of equivalence.
Yeah. It's an opportunity for some of us, Tony, as well.
That's what I say at the beginning. Always, even good regulation is an opportunity. It really is.
Yeah. Well, I think that's the challenge for people providing embedded finance like ourselves. We kind of recognize that to an extent, whether an organization operates in the UK or in Europe, you know, we've got to offer the same service, and we've got to take care of the complexity about issuing in two different places. So yeah, I think you're right, Tony. So look, we are kind of approaching the end. We've got 5 minutes or so left. We're going to go back to the start, which is our final question, which is, you know, is embedded finance a bubble that will inevitably burst, and that would be very sad, or is it a complete paradigm shift? So I'm going to go round, you know, take a minute to summarize, and but I need an answer, I'm afraid. So I'm going to start with Ivo, because at least then he can come back to me afterwards.
Well, I think there are two sides to the story. I mean, in my view, this is definitely a paradigm shift, and it's paradigm shift for a very simple reason. It's the way people perceive payments and finance. I think it was mentioned a few times during the discussion today that financial products as such are not really products. I mean, people, as Alex said, they don't go and buy a mortgage. They need a mortgage to buy a house. And the development of technology, embedded finance is allowing us now today to reverse or to change something that has been around for centuries and for millennia. And we had the banks and the financial products at a pedestal and something reserved for the big and mighty. And now we have democratized payments, and we have made it possible to move away the whole backend or all this experience which was required to go and buy your groceries, to make it invisible and make it seamless. So such a powerful trend driven by what consumers need and what consumers want, no doubt is going to continue. Now, the second part of the story, of course, is that once you have exponential growth and once you have industries developing at such speed, inevitably there will be a lot of sort of casualties along the way. There will be a lot of small bubbles popping up, the same way we had bubbles with the dot-com 20 years ago, the same way we had other bubbles in history. So from my view, it's definitely a paradigm shift, and I think the whole payment market is going to be refractured, and part of it will move and being sort of delivered in a different way to the consumers. But along the way, we'll have small bubbles appearing and bursting as well.
So I'm going to take that as a qualified yes. Tony, your view?
So I'm sorry, Ivo, to disagree, but it would be a shame if we agreed all the time, wouldn't it? I personally believe that this is another example of the continuous set of breaking waves in use of grammar and terminology in our industry, and that yes, it's an extension of the boundaries of influence of payments. Yes, it does require a change of thinking, but so many innovations require that. I think the question I've asked myself is, in 5 years' time, will we still be doing webinars on embedded finance? I'm afraid I don't think we will, because I think it's a step. It's an important step. It's a profitable step. It's an opportunistic step, but I don't think it's a paradigm shift myself. But let's see. The jury's open. There's still some more to vote.
So do you think that it's a bubble, or do you think it's
no? I think it's brilliant, because it's focusing our minds on addressing a new set of consumer needs, or a current and inherent set of consumer needs, in a creative and cost-effective way. It's going to create innovation. It's going to create business opportunities. Fantastic. But that'll just become absorbed into the fabric of this wonderful industry that we call payments. I don't think it'll be a bubble. I think it's going to be an evolving thing, but it's a step, not a paradigm shift.
Interesting view, Alex. How about yourself?
Well, so I would say that embedded finance is a paradigm shift, and if I like to describe it as I've done earlier, that it's all about asking your customer not to go to their bank, but to bring the bank to your customer, and that is a very fundamental way, the different way in which to sell financial service. The other reason I think it's not a bubble is that there's a real strong value story here. You know, the world works better with embedded finance than with finance being in a separate, you know, hill of its own with, you know, with a fortress around it. So again, this is something that has lots of room to run and run. What I would say though is about the overexposure of the term embedded finance. Every company in fintech that's doing processing and you know, any kind of service that can somehow has an API around it suddenly has become an embedded finance company. And you know, like any bandwagon, you know, it will lose its wheels a few rotations later. So, you know, I think it's a bubble of the term. I don't think it's a bubble of the concept.
Okay, I'm going to take that as another sort of qualified yes. Andrea, give me a less qualified answer.
It's 2-1, Mike. What's going to happen now? It's 2-1.
I think it's not a bubble. I think it's a trend. And it's a trend because it's driven by the client needs. So I think the market will adjust. Then if the traditional, let's say, financial provider are able to compete or are able to reposition themselves, that's a different question. But I think it's definitely a completely different trend that will change the way customer will see the bank, will see the insurance, will see the different provider of this kind of services.
Yeah, you see, that was definitely a less qualified yes. Alison.
Thank you, Mike. I don't think it's a bubble to the extent that I don't think it's about to burst or could burst. I think I agree with the concept that it's an evolution. And even to Alex's point, when you started off the conversation saying that there was embedded finance since, what was it, 1919 with car finance, you know, it's about customer demand and convenience, and rather than, you know, it's a broad, embedded finance is a broad thing. It feels like from what we've discussed today, covers many different variations. So I think it's more of when customers' convenience is at the heart of it, and you know, it's going to keep evolving and change over time. And to Tony's point, you know, perhaps we won't be so interested in the term in a few years' time, but we'll certainly be discussing new variations of it.
Thank you. Well, look, I think we've kind of all agreed it's not a bubble. I think we probably, the majority think it's a continuing trend, but whichever way we define it, I think embedded finance is going to do well over the next few years. So we've finished up. I'm just going to hand over now to Eva for a few closing words, and then we'll pretty much finish on time.
Thanks, Mike. Well, I very much appreciate your participation, and I would like to thank each one of you for taking the time and for sharing the insights. I think we had a really interesting discussion, and it's great, Tony, that we don't agree on everything, and that's part of it. It's brilliant. There is a lot of friction between sort of the ongoing regulation, maybe tougher regulation, and sort of trying to continue to democratize payments. But we are all looking forward to further developments in the space, and all of us, one way or the other, are going to be part of it. So again, thanks very much for the time. Thanks very much for your thoughts and ideas and participation, and we look forward to meeting you again soon. Thanks.
Thanks everyone. Merry Christmas.
Thank you.
Okay.